Hey everyone, me Kevin here. Good news, it's the last day of my vacation, so hopefully markets will rebound by tomorrow. But quick background on what the hell is going on in the crypto space, especially with massive developments with what's going on with Celsius and one of the largest crypto hedge funds. Attorneys are now involved. Folks, there are a lot of dirty things going on here. Let's get right into it. Okay, so quick background. We talked about Celsius a little bit already the other day, but some quick background. Celsius is supposed to be a fintech app that gives you high yields on crypto and stablecoins. They also give loans backed by crypto. Think of them as kind of like a Vanguard almost, although at this point that's kind of disrespectful to Vanguard. They've got some pretty classic catchphrases for a fintech, like military-grade security and withdraw your crypto at any time. Yeah, that's no longer true, by the way, because remember on Monday, they froze everybody's ability to actually swap or withdraw their crypto. Remember, not your keys, not your crypto. They also promise to keep your crypto safe and have next level transparency. Oops. They also say that traditional banking is broken, that you should unbank yourself, and that you should replace Wall Street with blockchain and really be part of the 99% and screw the 1%. So really like popular things, especially amongst younger individuals and mostly dudes. Now, one of the downsides of this is if you go to Reddit/r/Celsius network, you'll see a lot of individuals who have their life savings in Celsius, and now they can't get any of it out. And the problem could be because of what Celsius was doing with some of their coins. Now, some of this is part speculation and part, research based on what's going on the blockchain here, but we want to be very clear. We obviously don't have all of the details. But one of the reasons that Celsius is falling into issues is because of their promise to pay yields of between 7 to 17% on their stablecoins and crypto. But this is often done or achieved for Celsius through a manner known as recursive farming, which we're going to talk about in just a moment. But it's also achieved by continuously attracting new customer deposits. So while there are a lot of positive suggestions on Reddit for Celsius to just stop paying yields, people have to remember that Celsius is trying to attract new capital to pay people who are trying to get out. Unfortunately, that's also how Ponzi's work, and I'm not calling Celsius a Ponzi, but just saying. There's no surprise also that Gary Gensler, the chairperson of the SEC, and it's kind of like kicking you when you're down, but comes out yesterday and going, when you start getting promised double-digit yields, it's a red flag. But anyway, here's what's going on with Celsius and something known as staked Ethereum. Now, again, rumors, speculation, and some fact. We're putting all the pieces together that we can, but some of these things may not be perfectly accurate. And if you have more information, please comment them down below and let's vote up new information so we as a community can learn more. So, by now you probably know that Ethereum can be staked by locking up at least 32 Ethereum into the ETH 2.0 merge, the beacon chain, right? It's supposedly coming this year. Well, companies like Lido were really innovative because they gave you the ability to stake your Ethereum, that is, get yields on your Ethereum, without the lockup all the way to 2.0. This has given Lido control of almost a third, potentially even more at this point, of the entire Ethereum network because they have so much Ethereum staked. It's incredible. But via a smart contract, they can now allow you to receive staked ETH. So kind of think about this. Imagine you take Ethereum and that you have an Ethereum token and you kind of deposit it into a vault. And then the banker gives you a little piece of paper that says, all right, we owe you 1 Ethereum and we're going to call it staked ETH. So in theory, that piece of paper should be worth exactly 1 Ethereum. You should be able to go to the bank and go, give me 1 Ethereum, and they go, here you go. So it's basically a peg. It's a 1-to-1 peg. And in theory, because of this, Ethereum is more valuable in the short term because it removes the risk of that peg breaking. It gets the banker out of the middle, right? But as long as everything's going good and the banker's actually operating properly and you're getting that 1-to-1 peg, who cares if you have the paper or the token, okay? Well, this is where not your keys, not your crypto comes into play. Because, see, in the long term, Ethereum or staked Ethereum might give you this trading flexibility, but if there's a short-term panic, you might not be able to go to that banker and give your ticket to the banker because if there's a line of 10,000 people ahead of you at the bank, all of a sudden you have a bank run and they're not actually giving you tokens anymore, and they're just closing the vault saying, you know what, never mind, hold on to your worthless pieces of paper. Well, not necessarily worthless, because in theory they still have rights to that token in the vault, but this could be potentially part of what's happening over at Celsius. See, in order for Celsius to get the yields that they were promising so that they could actually run a potentially profitable business, if they're promising people, 7 to 17%, they got to make it up money somehow, right? So here's potentially what Celsius could have done. Celsius could have taken your Ethereum, put it into the vault with a banker, gotten staked ETH. Now, what they may have done with the staked ETH is conducted recursive farming. So recursive farming kind of works like this. Staked ETH can earn a yield, just like Ethereum can. And staked ETH, or STETH, can also be deposited as collateral for stablecoins. So imagine taking that piece of paper now and going to somebody else and going, hey, I want a loan from FTX or whomever, and I want, in exchange for me giving you my piece of paper saying I have staked ETH, I want 50% or 70%, depending on how high quality of a borrower you are, a bunch of loans against a staked ETH. And then that money can be then deposited into stablecoins, which could potentially provide a yield. And you could take that stablecoin and potentially then sell it and buy more staked ETH, and basically over and over and over again farm yields. Let me give you a really oversimplified example, because that may have sounded slightly complicated. But listen to this example, and I think it'll give you a lot of clarity. Right after, of course, I mentioned that if you want to buy stocks on an amazing brokerage platform and you want to take advantage of doing so with the potential of getting up to $1,000 in free stocks and no payment for order flow, go to metkevin.com/public. When you go to metkevin.com/public, you could get up to $1,000 in totally free stock. And you can buy stocks without payment for order flow or the fear that public is going to buy or sell your information. Instead, go to metkevin.com/public and get yourself up to $1,000 in free stock. So let's give this example here on yield. Let's say, and we're making this up, okay? But here's how this could work. This is called recursive farming. Let's say you have $100,000 and you stake it. You turn it into staked ETH and you get a 4% yield. Well, now in a year, you're going to get $4,000. But now I'm going to take those tickets, that staked Ethereum, and I'm going to farm stablecoins in a recursive manner. So I'm going to take those tickets, deposit them, and let's say I could get a 50% loan. This isn't even potentially making the argument that I could get an 80% loan because I'm such a good, big company like Celsius. So now I get $50,000 more dollars, which I then have in a stablecoin making 8%, or $4,000 again. Now I take that stable coin and I throw it back into the circle and I borrow on that $50,000 again. And then I stake that $25,000 now new dollars worth of stable coins at 8%. I make $2,000. Now I do it again. Use that new money that I've borrowed as collateral again. This could be at different exchanges or whatever. Now I get another 50% or $12,500. And then I get 8% on that, or $1,000. I do it again. I get $6,250 times 8%, $500. I do it again. I get $3,225. Stake that at 8%, or yield farm that at 8%. I get $250. If you add this all up, I turned $100,000 into $196,875. So $196,875, and now I'm making $11,750 per year, or boom, 11.75%. You could see if I could borrow up to 80% and I do recursive farming, I could probably get this number up to 20%, give people a yield of 17%, and profit the 3% difference. But this works as long as that staked Ethereum is worth the same number as, or the same value as Ethereum, and that stablecoins don't lose their pegs, right? If Celsius had any exposure to Lido, they would have lost a substantial amount of money. If they had exposure to staked Ethereum, which we know they have a lot, hundreds of millions of dollars of exposure to staked Ethereum, well, now you've got a problem. Why? Because Ethereum right now, at the time of this recording, is trading for $1,066. Staked Ethereum is trading for $1,002. $2, that's a $64 discount, or just over 5% of a discount. And the more that discount expands, the more money Celsius loses, because as people demand withdrawals, Celsius is actually having to pay people $100, but they're only getting out maybe $94 or $90 out of their staked Ethereum. This is a problem. How do we know they have staked Ethereum? Well, here's a wallet that we believe belongs to Celsius that has approximately $400 million worth of staked Ethereum, which is now only worth about 94 cents on the dollar. We're also seeing what we believe is Celsius sending thousands of staked Ethereum to FTX, likely to sell it. But a lot of those sale transactions happen in batches, and they happen off-chain, so it's actually a little bit more difficult to track. Now, Celsius is supposed to have about $10 billion in customer assets. Some say 5, some say 10. But the problem is, we've only been able to account for about $1.324 billion of that, according to Decrypt and this blockchain wallet that you have on screen now. The illiquidity of staked Ethereum could, however, now create a solvency crisis for Celsius. The reason for that is Celsius a few days ago says, hey, we've got plenty of Ethereum to cover withdrawals. Sure, maybe you did, while the peg between Ethereum and staked Ethereum was still 1-to-1. However, if let's say you had $5 billion of customer assets and you had thrown everything into staking or staked Ethereum or whatever, except for maybe 5%, to where you'd have maybe a $125 million cash buffer, but you just lost 5 to 6% on staked Ethereum depegging, all of your cash buffer and liquidity could be gone. And so now you're having to dump more assets, making or providing essentially more liquidity to something like staked Ethereum. But by providing more liquidity for staked Ethereum, you're actually increasing the supply of that, and then dropping the value of that, creating less liquidity for your company. And when your company has obligations of, let's say, $125 million in withdrawals, but all of a sudden you only have $120 million, who's going to lose that $5 million? Well, potentially an equal share to all of the people who had money with Celsius. And that now becomes a solvency crisis because of the depegging of staked Ethereum and Ethereum, creating an illiquidity crisis for Ethereum. You're actually creating the potential for insolvency over at Celsius. Well, now enter a report by the Wall Street Journal. The Wall Street Journal is now reporting that, reportedly, and this is based on people who are not authorized to speak on behalf of this matter, but reportedly, restructuring lawyers have been called in to enact emergency measures at Celsius. This, so according to Celsius at least, has nothing to do with the fact that Celsius token is down 62%. It's actually up 62% today, but even after being up 62% today, it's down 88% on the year. Celsius says, don't worry, this has nothing to do with our Cell token crashing, even though we had money in Cell token. Don't worry about that. But what we do have to worry about is the fact that now we got lawyers swooping into Celsius, raising fears that the Celsius lender might be facing mass liquidations, lawsuits, and a potential bankruptcy. Now, according to people familiar with what's going on at Celsius, Celsius has hired the law firm Akin, Gump, Strauss, Hoyer, and Feld. Dude, I don't know about the name, but anyway, apparently they are supposed to advise on possible solutions due to, quote, mounting financial problems. And again, the expectation is that Celsius could file for bankruptcy and that this could take years to settle. And remember what Coinbase told us. You are, as a depositor, an unsecured creditor in the event of a bankruptcy, which basically means you get last dibs after the bankruptcy. Now, some say don't worry, that restructuring is a positive thing, that if lawyers can come in and restructure the debt, then hey, maybe you could get your money back out. But let me tell you, any lawyer renegotiating a debt restructuring generally only gets a restructuring if equity is given up or underlying assets are shaved. That is, maybe there's a debt restructuring and the lenders take a haircut, but usually only if people with assets in the company take some form of a haircut as well. How much will that end up being? Well, it depends on the extent of the problems. 5%, 10%, 50%, who knows? Either way, many are now suggesting that Celsius just give people their money back. Obviously, I imagine they would want to do that, but they probably don't have enough money to pay off their debt and pay people back. This is despite the fact that they're starting to pay people back. At least if you look at their blockchain activity, it does look like Celsius is starting to pay off some of their debt. But, and then there's speculation that maybe Celsius won't have issues until wrapped Bitcoin hits a low of 14,000, which hopefully we're far away from. We're sitting at, just above 20,000 right now. But hey, we were sitting above 30,000 not too long ago. So we'll see what happens. Anyway, this is creating a lot of fear. And it's leading other companies to collapse as well. Take, for example, 3AC, one of the largest crypto hedge funds, supposedly with $18 billion in assets under management. Huge number, by the way. 3AC is rumored now to also be insolvent, meaning they can't cover their margin call. Now, this is a rumor, and there's no confirmation yet. However, the CEO did tweet, or the co-founder did tweet, quote, "We are in the process of communicating with relevant parties and fully committed to working this out." Kind of a cryptic tweet, which again is raising fears that now the largest crypto hedge fund is underwater. Now, this company also borrows from every single major lender like BlockFi, Genesis, Nexo, and Celsius. And so if they're going insolvent and they borrowed a ton of money from, let's say, Celsius, and they can't repay Celsius, well, no wonder Celsius would be having issues. But this also means all of the other platforms could be having issues. This one Twitter user who's been pretty detailed about providing information, called Hodl Kryptonite, at Hodl Kryptonite, did give a hypothetical example for 3AC. They suggested that if half of 3AC's assets under management went into venture capital funds, so basically money that's usually locked up until like an IPO, like 5 to 10 years out, then that money's locked up. It's not liquid, right? So $9 billion, let's say, goes into, again, venture capital funds. The other $9 billion goes into, let's say, liquid assets like Bitcoin. Well, if they did that in November, they'd be down 70% on their liquid. They'd literally be down to $2.7 billion, barely enough to probably cover margin calls, depending on how much they borrowed. And if you're losing 70% on the assumption of having been invested in the safest asset, what happens if all of a sudden they also had exposure to Terra Luna or, dare I say, the shoot coins? Because presumably if you're a crypto hedge fund, you wouldn't only be putting your liquid into Bitcoin because, hey, you're a hedge fund. You should be able to find better deals, right? Anyway, long story short, the best way to protect yourself is to make sure that you have your hands on your keys. Not your keys, not your crypto. Thanks so much for watching, folks, and we'll see you in the next one.